Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to talk about the Upstart stock. It has been going crazy lately on some record earnings. So I wanted to give you my thoughts on where I see it going, break down the fundamentals with you, and then also give you my Upstart stock price prediction for the end of 2021. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Hit that little bell so you get notified every time I post. There's also a link down in the description to my Patreon account. Come over and join the family. We've got an awesome community over there. You'll get access to the private Discord where we talk stocks. You can ask me questions whenever you want. You'll also get access to 5 different portfolios so you can see exactly what I invest into. And then anytime I buy or sell a stock, up to the second I do it, I send it out so you can follow along. I also send out a lot of like swing trade setups anytime I map a chart or I've got a watch list, really just anything that can help us become better investors. There's also a lot of education over there so you can really take your trading to the next level. So if that's something you're interested in, come over and join us. I think you'll get a lot of value out of it. Day one squad. I love you guys so much. Thank you for your support. It means the world to me. But guys, let's get started. Today, I wanted to go over Upstart stock. They have been going insane lately. The stock has been doing very well, outperforming a ton of other stocks. And I wanted to kind of look at the overall, kind of top-down view of how the stock is not only performing on the charts, but also their fundamental aspect, the valuation metrics. This is going to be a very similar video to the Roblox video, guys. The reason why I've been doing these videos is because I want to show you my process of when I'm scanning for a stock, how I look at it from start to finish. I want to say right up front, I have not done a ton of due diligence on this company. I don't know their growth story. I don't know their expansions. I don't know what they're doing, moving forward. I don't know any main catalyst. So if I say something that you don't agree with because of a long-term catalyst that you know about that I don't, that's not what I'm doing here. What I'm doing here, guys, is taking a top-down look, a real brief overview of the fundamentals and the chart, and getting an idea if we want to take a look much deeper and do a full analysis of it that takes much longer than just a scanning analysis. That's how you have to look at stocks, guys. You can't do full deep dive, unbelievably, in-depth analysis on every single stock you look at. You got to have a process that you can go in, you can find those stocks that are undervalued or mispriced by the market, add them to a list that you will then go back and do much deeper dives after that. You can tell real quick if a company is even close to your overall core, guidelines of what you want a company to look like when it comes down to fundamentals. If you can't tell within 15-20 minutes if it's a stock you even want to consider, you probably need to change your process. At least that wouldn't work for me. So, but let's get started, guys. First thing we're going to look at here is we're going to go over the earnings report because it was massive. We're also going to take a look at the overall just kind of overview, valuation metrics, income statement, and then we'll take a look at the chart and we'll wrap it up. And I'll give you my Upstart stock price prediction for the end of 2021. So as you guys can see right here, they had a pretty big beat on earnings. The earnings looked great. What was really impressive, though, was the guidance that they increased. So as you can see here, non-GAAP EPS, they reported about 62 cents, which was a beat of 37 cents. And then GAAP EPS, they reported 39 cents per share, and that was a beat by 27 cents. So pretty nice there. Revenue of 139.95 million, which was a beat by 36.2 million. So they did really good, at growing that top end there. Now look at this, guys. The revenue guidance for full year 2021 was previously 600 million. They just upped it to 750 million. That is an insane jump on guidance. We have talked about multiple times where companies increase their guidance, they miss on guidance, and the stock gets murdered. So we've got to be very careful, on those companies that are, posting just insane outlook and insane guidance, because if they don't hit that, it's not going to be pretty. Now you can see here as well, they also upped their contribution margin about 3% and their EBIT margin, adjusted EBITDA margin of about 7%. So not only are they pretty confident that they're going to grow their top end, but they also believe they're going to grow and lift up their bottom end. Very important, guys. They must be extremely confident that they are going to have a very strong, second half of the year in order to bring it up that much. For those of you guys that do not know who Upstart is, I'll give you my kind of 10-second elevator pitch. They are a AI-based lending platform that they pretty much are a middleman for banks and consumers. So for example, if I needed to get a personal loan, I would go to Upstart and fill out their application or use their platform, which considers over 1,000 different metrics to approve me for that loan or not. So they have gone into an industry that has been really undisrupted for a century, that has a very traditional, credit system, the TransUnion, the Equifax, the FICO credit score system that is very, one size fits all, just very canned approach that has not changed. They have disrupted that because they are giving these banks a plethora of more, metrics to look at to consider people to pay their loans or get approved for their loans. Next thing I want to look at. So this is kind of the overview, guys. This is the first thing I look at when I am considering a stock. I go in here, I get an idea of what the company does, what industry they're in, what competitors they have, things like that. And then I kind of come down the list and I say, okay, what kind of volume does the stock have? So they've got 9 million shares traded today. Their average 3-month volume is 5.1 million, which is great. We want to try to, trade stocks that have a lot of volume. I know none of us probably have issues with getting our orders filled. We're not whales for the most part, but at the same time, you don't want to trade an e-liquid stock that doesn't have any volume. Next thing I look at, and probably I would say one of the most important, guys, is their shares outstanding and their market cap. So as you can see here, they've got about 77.77 million shares outstanding, and then they've got a market cap of about 15.8 billion. That's a big market cap, guys. So we really got to see, is that market cap justified or is the stock overvalued? As far as, then you can look and see, okay, they've got 16.28% held by insiders and 35% held by institutions. I do like to see stocks with a lot of institutional investors. Kind of shows that the quote unquote smart money, is investing in the stock. Now, as you guys can see here, PE ratio of 221. That is a massive PE ratio. Guys, just right off the bat, this stock is not cheap. You are not getting a discount on it. You are absolutely paying a premium on this stock. Now, guys, we've got to kind of decide, what are we willing to pay, because they are growing so much. This is a big thing that I think a lot of people have an issue with. We should be willing to pay more for a company that is growing faster, but you have to kind of find that happy medium of how much more are you willing to pay. You can't just pay whatever it takes because a company is growing at insane rates. There's got to be a limit there. If you look out through history, guys, there has been a unbelievable amount of companies out there that if I would have, looked back 10 years ago and said, okay, they're going to grow at, 10 times over the course of the next 10 years, where do you think the stock price will be? A lot of people would probably say, 10 times higher, but it doesn't always work that way. Look at Amazon. Amazon grew their revenue at an unbelievable amount over the course of the last 10 years, and the stock price has absolutely grown an unbelievable amount, but nowhere near as fast as the revenue grew. So go look at that. I don't know what it is. I would have to go out and do the math, but I would imagine that the revenue for Amazon has grown at least 10 or 15 times faster than the share price. So just something to keep in mind, guys. Now look at the price to sales ratio, 20 times revenue. So typically you want to pay, 15, 20 times earnings. You're paying 15, 20 times revenue. So now again, with a fast growing company, I don't really necessarily look at PE ratio when I'm more so looking at growth stocks. I look at sales and cash flow. I will disregard a negative PE or no PE because they have negative earnings on a growth stock, because I'm more considered with A, growth, and then B, free cash flow. So just something to keep in mind there. Price to cash flow ratio 71, guys. That's insane. They're literally selling for 71 times their trailing 12 months cash flow. That's a massive multiple. As far as gross profit margins, 86.52, which is a huge gross profit margin. That is very good to see. We want to see that. As far as the EBIT margin, about 17%, not bad there, pretty decent. Net margin, 12.3%. I would like to see that come up a little bit. The net income margin does seem a little bit low to me. If they could do things to get that bottom line up, I think obviously that would cut their valuation metrics down, make the company look a little bit more, valuable, or a little bit more fair valued, not so overvalued. Now, as far as the revenue in the trailing 12 months, the growth on that revenue was about 26% over the trailing 12 months. But let's take a look at the income statement, guys. That's really where we can kind of see how they're growing. As you guys can see here, we've got about 4.5 years of data. I like to look around 3 to 5 years historically, but if a company is really started excelling growth in the last year, year and a half, 2 years, I will really kind of drop those 3 years previous to give it more of a fair value. As you can see here, 66.7, 125.8, 190.7, 241.4, and 472.4. Guys, that is very quick growth. If we look as a year-over-year growth here, you can see that they are currently growing 88.5% in 2018, 51.57% in 2019, 26.3% in 2020. They don't have the full year out, but they just raised their guidance to 750 million. So that puts their, if they hit that metrics, their 2021 revenue growth would be 3 times. So, much better than what they have been doing previously. But if you noticed from 2018 to 2020, their revenue growth was slowing and now it is starting to accelerate again. So is that sustainable? I don't know. That's an assumption you have to make. One other thing I wanted to look at, guys, is the cost of revenue. If you guys remember from the Roblox video, the cost of revenue was growing faster than the actual revenue. That is really bad. You do not want to see that. As you can see here, guys, the cost of revenue is nowhere near. It's pretty much staying about stagnant, about the same, and not growing anywhere near as fast as the revenue, which is very positive. As you can see, the gross profit is growing very nicely, keeping up with that revenue growth, and the cost of revenue is staying about the same, and even in some instances going down. So very impressive. If you ever see a company that the cost of revenue, the fixed cost, is growing up, just as fast as the revenue, if not faster, that's bad, because if you can't ever become profitable, it doesn't matter how fast you're growing. You've got to find that point of diminish where your gross profit goes up, but your cost of revenue goes down. So now, next thing here is the net income. As you guys can see here, they really just reached profitability back in 2020 at 6 million. So they were negative 7.7, negative 12.3, negative 500K, and then positive 6 million in 2020. Now in their trailing 12 months, guys, they're at 58.1. That is huge. So they really just, like, I don't know what happened. That's something you would have to, investigate for yourself and do in that deeper dive, is find out why the net income jumped so much this year or in the trailing 12 months. Like, is it going to end up that way at the end of the year, or does some crazy influx of costs come in right there at the end of the year that cuts that net income down? Again, those are things you'll have to do on your deeper dive. But from what I can see here, that is beautiful net income growth. Again, I would like to see that net income margin come up a little bit so that they can get that net income, profit overall a lot higher. Now, one other thing I wanted to look at, guys, just before we jump into the cash flow statement, is the balance sheet. When you look at the balance sheet, you want to look at total current assets over total current liabilities. So as you guys can see here, total current assets 712.8, and total current liabilities is 83.4. So that is a very, very healthy balance sheet. They have more than enough cash on hand to pay off all their debts pretty much 10 times over again and be just fine. So if any, big issue happens, a black swan event, they will be just fine. They've also got enough cash on hand to make acquisitions, grow, do things, buy back shares. That's a big one. If we take a look down here, guys, this is a big one. We can take a look at the total common outstanding shares. Look at how fast it's been growing up. 13.9, 14.1, 14.6, 73.3. So they've been issuing a ton of shares in the last year. Back here from 2017 to 2019, the shares outstanding didn't grow very much, so they weren't issuing more shares. But in the last year, again, this is something you'll have to look and see why they issued that amount of shares, probably to raise capital. But they diluted you by a 7 times pretty much in the last year. So are they going to continue to do that? And they've even issued more shares in the trailing 12 months. Guys, the way you look at it is just you have 10, say there's 10 shares in a company and you own one of them, you own a tenth of the company, and then they issue 10 more. So now there's 20, you own a half of a tenth, fifth, whatever it is of the company. So, you definitely want to find those stocks that the shares are going down or staying the same, not going up a tremendous amount. But 90% of the time, growth stocks like this that are growing rapidly, they're innovating, they're doing things to get that overall revenue up and market share up. They're gonna issue shares. They're gonna take advantage of high share prices to generate money and do share offerings. So not a huge concern there, guys. I'm not really concerned with that. Especially in a newer company like this. If it was like a value stock that I was planning on buying and holding for 20 years, obviously I would want to see that go down. So just something to keep in mind. Now, as far as the cash flow statement, guys, this is what I really look at. This is the most important for me. For those of you guys that do not know, free cash flow, you go to the cash flow statement, you take your cash from operations minus capital expenditures. So as you can see here, guys, you've got 10.4 minus 0.8. So 10.4 million minus 800,000. So they did, about 9 million in free cash flow there, 50 in 2018. They had a down year in 2019 and 2020. Not too bad in 2019, but a really low year in 2020. So guys, look at the cash flow was really starting to grow right there from 2017 to 2018, and then it started going down. But look at the trailing 12 months, guys. They went from like 14 million in free cash flow last year to 220 million in free cash flow in their trailing 12 months. So that is a big jump there, guys. Now, one thing I want to mention, the way you find that price to cash flow, guys, is you take that 220 million and you divide it by the market cap, which was giving us that like 72 times, cash flow. Now, if they do hit that 72 or 750 million as their guidance, and the stock was to trade at the exact same cash flow, price to cash flow as it is today, the stock price would have to be like $320 something to maintain that same price to cash flow, ratio or valuation that it has today. Now, that probably isn't going to happen, but just a thought. Their cash flow margin is really big right now. It's like 47%, which is unbelievable, very impressive. Because as you can see back here, their price to their cash flow margin was nowhere near that. So, okay, guys, last thing here. This is just pretty much a simplified version of a discounted free cash flow, sheet to come up with an intrinsic value of a certain share price. And the reason why I like these sheets, guys, is because you can come in here and you can put your assumptions in on, if they grow at X percentage or if they have this for their cash flow margin or whatever those numbers may be. So you can see how that will affect the share price. You can also say, I want a 20% return on average a year. So then you can come and see and what the company would need to do to hit that, return percentage. So as you can see, I put in the metrics, I put in the share price, the diluted outstanding shares. I also put in their most recent revenue, most recent net income, and their most recent free cash flow. As far as growth rate for the next 5 years, guys, I put in 40%. So how fast will the company grow their earnings over the next 5 years? I put in 40% a year. That's pretty aggressive, guys. Do I think they can do that? Probably, but when you're doing things like this, you should probably be a little bit more conservative, but I wanted to give them the benefit of the doubt. Growing your earnings at 40% is not easy to do, especially as your company gets bigger and bigger, but we'll just leave it there. Now, as far as the net income margin, they're currently doing about 12.6%. I just put in 13%. The net income margin doesn't really affect this, price target because it's a cash flow, statement. So, and then the cash flow margin is where I went really aggressive. They currently have about a 46% cash flow margin, but is that sustainable? Those are the assumptions you have to make. And I want to show you, just what that would look like with a couple different percentages. Is that 46% cash flow margin sustainable? I don't know, guys. I mean, seems pretty high for me. I would probably want to count on more of like a 35%, but again, we'll give them the benefit of the doubt. And as you can see, with all of those numbers combined, This sheet gives us a intrinsic value per share at around $212, which gives us about 3% upside from here. But look at this, guys. Even if I drop that from 46 to just 40, it drops that intrinsic value per share to $184, which is 10% downside from current levels. If we drop it down to 35%, that gives us $161. So what I'm getting at here, this stock is not cheap. In my opinion, it could potentially be a little overvalued. I am not buying it today because in my opinion, it's just a little too rich for me. I would like to see the share price come down, especially after this massive run up. It's not a long-term hold for me because I don't see enough value in it. I don't see enough upside at current levels. Now, can that change in the future? Absolutely, guys. This share price could come way back down. And for me, in order for me to, buy it and take a position in it, I would need to see it more around $110. That's just kind of where I'm at. So overall, you can kind of come up with your own idea, your own assumption, but that's what I'm getting on the sheet and that's where I'm at. But that's not to say that I won't trade the share or the stock on the short-term volatility based off chart patterns. Now, one other thing I wanted to show you guys, if we leave the cash flow margin at 35%, but let's just say they grow at a crazy rate, and let's just say they grow at 75%, because based off their projected earnings, guys, they're projected to grow at around like an insane number for 2021, but then every year after that, it goes down. So like 2022, 2023, and 2024, it drops every year from there. If they grow at 75% for the next 5 years, it's given us an intrinsic value per share of $473. So there also could be a lot of upside, guys, if they can maintain what they're doing this year. Again, all investing is making assumptions, trying to find the most realistic assumptions, and finding those stocks that the market has misplaced. I don't believe the market has misplaced this yet, because I don't believe that they have proven that these growth rates are maintainable. So with that being said, guys, let's move on to the chart. All right, guys, this is what I really wanted to look at because this chart is incredible looking, guys. This is probably one of the best charts across the market right now. As you guys can see, this is the daily chart. Ever since this stock IPO'd clear back here in December, it has done nothing but make higher highs and higher lows its whole life, like it's its job. You can see here, it came out and hit an initial all-time high back on June 4th at 191.89 before selling off. Okay, guys, look at the bearish divergence, Class A bearish divergence you had right here on this high, and look how poorly it played out. That shows you just the unbelievable strength that the stock has. Then it came down and had a big momentum shift where it found support at these highs from back here in May, and then had a massive amount of accumulation, guys. That is a trade setup right there. You can call this whole structure an ascending triangle, call it whatever you want, but overall you had that momentum shift, you had your accumulation and your big gap up on earnings, and you just about hit the first target of the trade setup today. Guys, look at this confluence right here. You take your fib extensions, and your target is right there at the 1272 fib extension. That is insane confluence as well. If you drop down to the 4-hour, guys, look at all 4 of your main moving averages clumped up in a tight little range right there. Again, that confluence is extremely bullish. You were testing your 200-day moving average for a few weeks on the 4-hour. The last time you had done that was back here when it first originally painted back here in May. So very, very strong, guys. Now you're just about there at the 1272 at the 215 price target for the trade setup. You really could go to the 1414 up there at 228, and then even 245 up there at the 1618 fib extension. So this thing has so much more upside that it's impending. Now, do you want to buy it right here? Probably not, because there's just not a strategic entry. These are not low risk areas, guys. This is something that you would want to wait for a concise lower risk entry at a major support level. You're right in no man's land price discovery right now. Again, you would use your fibs for your price targeting there. But guys, yeah, you had the bullish ABDC, you ran up, pulled back, blast off, and now you're up here, above. This was your major inflection point. I mean, you had your initial all-time high from back here in March 19th. and then you had your second initial all-time high back here in June, but it got rejected at this level before selling off, shifting momentum, blasting off. You need to see it confirm it as support. Like, you got to get that back test of the top of the range to confirm to investors that once was a pretty significant resistance level is now certainly support. Other thing, guys, is you had your highest level of relative strength since back here in March on the daily. Same thing with your positive momentum. Highest level of positive momentum since back in March. Guys, last thing, the last time you had negative momentum in it was back in July as well. So, there's probably going to be some pullback here, but that's honestly kind of gambler's fallacy, because I know a lot of the times when stocks just keep going up, a lot of people are like, well, they're bound to pull back. Again, that's kind of gambler's fallacy, because there's nothing implying bearish sentiment right now. You're way up in the bullish control zone on your RSI. So, I guess you could technically say it's probably overbought, which means it could potentially pull back. But in reality, it could just pull back, to test the top of the relative strength index and then just, run back up. So, again, I wouldn't buy it right here, but this stock is powerful. Very, very, very nice. One last thing I wanted to show you guys. This is really what makes me like it so much. Guys, this is a textbook 3 rising valleys pattern on the weekly chart. Okay, so this is for those of you guys that have read the Thomas Bulkowski Encyclopedia Chart Patterns, this is a continuation pattern. It's ranked like number 6 out of a lot of the other continuation patterns, so it is very bullish. And we just had a confirmed breakout on last week's weekly candle that confirmed the 3 rising valleys. So guys, you had your first valley, your second valley, your third valley, and when you get a candle close above the highest peak of the last valley, that is when you confirm your pattern. Guys, if you take that measured move, that's how you measure the price target on a 3 rising valleys. That puts you clear up here at like $343, which is massive, massive price target. Now, guys, you got to keep in mind, this is like an 8-month structure. This is a huge structure, so that is not going to play out overnight. You're not going to get to 343 within a week. It's going to take months to get there. This would be more of like a position trade. And what you would really want to do is you would want to wait until you got a candle close above this, confirming this as support, back testing it. So with that being said, you did back test it and you are above it now, but that candle's not closed. Guys, you would want to wait until this candle right here confirms that you are holding this level as support. The other thing, guys, is you also had hidden bullish divergence on your last low. Guys, anytime you have like an inverse head and shoulders or a 3 rising valleys, you always want to have hidden bullish divergence going into your last low. So for example, on your, from your head to your, right shoulder, you always want to have where the indicator makes a lower low, but the price makes a higher low. Going into the structures, you want to have, a lot of the times you'll have classic bullish divergence. So going from like the left shoulder to the head, where the price makes a lower low, the oscillator will make a higher low. So you'll get class A bullish divergence going into the inverse head and shoulders or the 3 rising valleys, and then you'll get hidden bullish divergence coming out of the structure, the inverse head and shoulders or the 3 rising valleys, which is impending price action continuation to the upside. So very, very powerful stuff, guys. You don't want to ignore that. This is everything you want to see. You also want to see those 3 rising valleys on a significant time frame. You don't want to see them on like an hourly chart. You want to see them on a daily or a weekly. You also had your first bar of positive momentum on your histogram that just started today. So very powerful, guys. This is something, again, that I would wait until you got a back test. You confirmed this, breakout level as support before getting into it, and then you set your stop loss and forget it, because this is a position trade. It's going to take a lot of time. It's not going to get there overnight. So you would set your stop, below the breakout of the third peak. You would set it down a little bit further, probably a little bit of a looser stop than most people, and then you just wait. So, but that's it for today, guys. Thank you so much for your support. This video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. I love you all. Come join us at the Patreon. Have a beautiful day. Peace. Peace.